Okay, this video covers accounting for leases. We'll do some lease basics, talking about what is a lease. Second, we'll talk about the two different types of leases for accounting purposes. And third, we'll use an example and go through the basic accounting rules for leases. First, lease basics. What is a lease? Here's the definition. A lease is a contractual arrangement in which the lessee makes a series of payments to the lessor in exchange for the right to use an asset for a specified period of time. Let me show you an example. So let's suppose we have a bank here. This is a bank. And they're going to lease an asset to Southwest. What type of asset? They're going to lease an airplane to Southwest. So the bank owns the airplane. Southwest writes up a promise to make lease payments to the bank, and then they trade. So Southwest now has the right to use the airplane, and the bank has the expectation that they will receive lease payments. So how does Southwest account for this type of arrangement? Well, there are two different types of leases. If the lease, so we'll talk about finance leases and operating leases. First, finance leases. If the lease terms are economically similar to purchasing the asset, for example, the lease term is a major part of the remaining economic life of the asset, then it's a finance lease. So what does this first part mean? Let's talk about the airplane. If Southwest signs a lease and the term of the lease, the amount of time they're leasing the airplane, is substantially all of the economic life of the airplane, well, they're essentially buying that airplane. So it's similar to a purchase, and they'll treat it as a finance lease. If it's anything else, so it's a short-term lease or there are other criteria that they go through, we'll consider it an operating lease. Okay, so these are the two different types of leases for accounting purposes: finance leases and operating leases. First, let's talk about, now we're going to talk about accounting for leases. And first, we'll talk about the initial measurement. Whether it's an operating or a finance lease, the initial measurement is going to be the same. When Southwest leases that airplane is now recognized on the balance sheet, along with an offsetting liability representing Southwest's obligation to make lease payments. So here's what the journal entry is at the inception of the lease. It's a debit to an asset account, and I've put right of use asset here. This is typically what it's called within the company's accounting system. Maybe not what it's called on their financial statements, but right of use assets, just an asset account. They'll debit that account. They'll credit the lease liability account. What is the X? So I have $X. What is the amount that Southwest will debit and credit these accounts? Well, X is equal to the present value of the future lease payments. So Southwest will plot out the future lease payments and discount them to today. So what is the current day cost of making those future lease payments? Southwest will record that amount as the amount of the asset on its balance sheet and the amount of a lease liability obligation on its balance sheet at the inception of the lease. And this journal entry has a bit of a caveat. The amounts might actually differ by a small amount. And that happens if certain things like upfront lease costs are involved. Those amounts might differ by a small amount, but the general idea is the same. You will debit an asset account and credit a liability account for essentially the present value of the future lease payments. Okay, subsequent measurement. So after we've recorded this asset and liability, what do we do after that? Well, for an operating lease, we record lease expense and we recognize it evenly over the lease term. For a finance lease, it's slightly different. We have lease expense being really heavy in the earlier part of the lease term and lighter on the later part of the lease term. So in a finance lease, you recognize a lot of expense up front and not so much in the future. Whereas an operating lease, lease expense is flat over the term of the lease. Okay, now let's go through a specific example of a lease between Southwest Airlines and a bank. And the start date of this lease is December 31st, 2018. The end date is December 31st, 2020. Southwest agrees, when they get the right to use the airplane, to make payments of $537,805. They'll make those payments at the end of each year. The implied interest rate based on those payments is 5%. And you'll see why it's a kind of a particular number a little bit later on. But the implied interest rate based on those payments, so 2 years of payments of that amount, is a 5% rate of return for the bank. Okay, so let's go over the journal entries now. December 31st, 2018, Southwest signs the lease and obtains the right to use the airplane. So first they need to calculate the present value of the future lease payments. Here's the schedule of the future lease payments. At the end of the next year, they'll pay $537,805, and of the following year, they'll pay $537,805. Southwest needs to discount these payments to today. So they'll divide each of these payments by 1 plus the implied interest rate in the lease. And that quantity is going to be raised to the power of the number of periods to be discounted. So raised to the power of 1 for the first period's payment, and raised to the power of 2 for the second period's payment. And so these amounts are the present values of those future lease payments. You can see that the present value of the later payment is slightly smaller than the present value of the earlier payment. When you add those numbers together, here's why I chose $537,805, because it ends up being $1 million in terms of the present value. So Southwest's, the present value of that obligation is $1 million. And they're going to record that amount as an asset and a liability on their balance sheet. And here's how. Now here I've said they've debited a PP&E account. This is typically what you'll find on financial statements when you go out and look at public companies. They'll typically just put these right-of-use assets into their PP&E account. So here I have Southwest just debiting a PP&E asset account for $1 million and crediting a lease liability account for $1 million. So that's the initial measurement of this lease. Okay, next, let's talk about 1 year has gone by. It's now December 31st, 2019, and Southwest is going to make that first lease payment. First, we'll talk about a finance lease. There are two entries that are made for a finance lease every period. That's because we're going to treat the asset different from how we're going to treat the liability. So step one is we're going to depreciate the asset. We will depreciate the asset over the lease term. Step two is we're going to amortize the liability. So step one will depreciate the asset. Step one will amortize the liability. They're separated because we're treating them slightly separated, as if they are different elements. So this asset, remember, was $1 million asset, and we're depreciating it over the lease term, which is 2 years long. So we'll record 1 year of depreciation expense of $500,000, the $1 million asset divided by 2 years of the lease term. And we'll credit accumulated depreciation, which is, remember, that contra asset account attached to the PP&E account. So the PP&E balance started at $1 million, then it went down by $500,000 after the first year. That's depreciating the asset. Now let's amortize the liability. And we do this in exactly the same way as we did for a bond. The only difference is this bond has a face value of 0. So let's talk about how to do that. First, we'll calculate interest expense. The answer is interest expense is $50,000. How did we get there? Well, we took what is the effective interest rate in the lease of 5%, and we multiplied it by 1 million. Now, 1 million is the beginning book value. It's the beginning book value of the liability balance. So beginning book value times the effective interest rate in the lease of 5%. Interest expense is $50,000. The next part of this entry is paying cash. Remember, we're making that $537,000 interest payment, lease payment. So we credit cash for that amount. Now, same as a bond, the difference between the cash payment and interest expense amortizes the liability balance towards face value. And face value in this case is 0. So we'll be amortizing this liability balance towards 0. So the difference between these two amounts plugs the journal entry. It's $487,805, and it's a debit to the lease liability account. It reduces that account towards 0. Okay, so that's the first year of the finance lease. Now let's go through the first year of the operating lease. Now this part is slightly different. We're going to recognize expense. I'm abbreviating here. We're going to recognize expense. And remember that expense is just recognized evenly over the lease term. And second, we're going to amortize the asset and liability. So first we'll recognize straight line expense, and second we'll amortize the asset and liability. So how much straight line expense are we going to recognize? We're going to recognize the amount of the payment. So we pay this lease payment in cash, $537,805, that's a credit to cash, and we debit rent expense, $537,805. We're going to make the same amount as a payment next year, so the expense is going to be flat. Now we amortize the asset and liability, and the rule is you just amortize it at the same rate as what you amortize the liability in a finance lease. So you'll see that the same number, $487,805, is the amount that we amortize the lease liability. It's also the same amount that we amortize the lease asset here. So the asset and liability are decreasing towards zero at the same rate in an operating lease. So that's the first year of accounting for an operating lease. Okay, now let's do the final year. Remember, we're going to depreciate that asset again, $500,000, $1 million over 2 years. So now that asset is depreciated down to zero. It's gone from the balance sheet. The lease is over, you give the airplane back, the asset's gone. Okay, now let's make the liability go away. We debit interest expense, this time for $25,610. Slightly different this time because the beginning balance of the liability is different. Remember, the beginning balance of the liability started at $1 million, but then back in 2019, we amortized it by $487,000. So now it's a smaller beginning balance of a liability. We're multiplying it by that same 5%, and we get interest expense of $25,610. This is just a formula to arrive at interest expense. Okay, the next part of the journal entry is making that cash payment. Credit to cash, $537,805. That's the lease payment. Remember, the difference between the cash payment and interest expense amortizes the liability to zero. So we'll debit the lease liability this time by a bigger amount, $512,195, and now it's down to zero. So if you take $1 million, subtract $487,805, subtract $512,195, that liability has now reached zero because we no longer have any obligations to make more lease payments. So the asset is gone, the liability is gone, and the finance lease is over. Okay, now let's end this operating lease. So if this were an operating lease, what would we do? Well, remember the first part is recognizing that straight line expense. Debit rent expense and credit cash for the amount of the lease payment, $537,805. The second part, remember, we need to remove the asset and liability. They need to go to zero. So we're going to take that number down here again. And we're going to finish amortizing the lease liability with a debit to zero and amortizing the asset by crediting the accumulated depreciation account to zero. And so now we've finished the operating lease and now we're all done with this example. So just to recap, when a company leases an asset, we as accountants assume that that asset is now a right to use, it has value, it comes onto our balance sheet. So we'll recognize the asset on the balance sheet. What does the asset represent? It represents the value to the company because the company has the right to use that asset. So it's an asset. We also recognize a liability when we start the lease. What does the liability on the balance sheet represent? Well, it reflects the obligation to make future lease payments. That's an obligation of the company. Now, expenses are recognized on the income statement over the lease term, but those expenses will differ depending on whether the lease is a finance lease or an operating lease.